Greetings and welcome to the latest episode of Legal Bites, the official podcast of Cummings and Cummings Law, where we focus on helping businesses and their owners re-domesticate out of volatile legal and tax environments like the District of Columbia to predictable pro-entrepreneurship, pro-growth states like Florida and Texas. Today, we are discussing how to move your existing LLC or corporation out of DC to a new jurisdiction to avail yourself of tax benefits, among other advantages. But first, a brief introduction. My name is Chad Cummings, and I am an attorney and a certified public accountant serving clients in matters of business, tax, and commercial law throughout the states of Florida and Texas. I am Chief Executive Officer of the multi-state, multi-attorney law firm Cummings and Cummings Law. And in addition to my day job, I also teach business and tax law at the university level. I hold 4 degrees, including 2 law degrees, as well as a bachelor's degree in accounting and a master's degree in taxation, in addition to 11 professional licenses and certifications spanning accounting, tax, audit, and of course, the law. My firm website is www.cummings.law. The District of Columbia collects $15,009 in tax revenue per capita per year. That is the highest figure in the country, higher than New York, higher than California, higher than Connecticut. And despite collecting more per person than any other jurisdiction, DC carries $32,166 in debt per capita, a figure that dwarfs every state in the union. The district taxes more per person than anywhere else, and it still owes more per person than anywhere else. That math does not work, and that is the fiscal profile of a jurisdiction that cannot control its spending regardless of how much revenue it extracts. DC ranks as number 48 on the Tax Foundation's most recent State Tax Competitiveness Index, tied with California. Only New Jersey and New York rank worse. DC has held a bottom 10 position for over a decade. It imposes a graduated individual income tax with 7 brackets and a top marginal rate of almost 11%. The brackets are not indexed for inflation, meaning the real threshold for reaching the top rate decreases every year without legislative action. And the corporate income tax rate is 8.25%, higher than Virginia and comparable to Maryland. DC includes global intangible low-taxed income in its corporate tax base, making it an outlier nationwide and penalizing companies with international operations. DC does not allow full federal bonus depreciation, requiring businesses to add back first-year capital investment deductions taken at the federal level, and DC imposes an estate tax, adding another layer of exposure for business owners and families engaged in succession planning. DC's property tax structure contains a provision that is unique in the country and not in a good way. The district offers a $225,000 de minimis exemption for tangible personal property, which sounds generous on its face. But unlike every other jurisdiction with a de minimis exemption, DC's exemption is a liability exemption only, not a filing exemption. That means a small business with personal property below the threshold owes nothing in tax, but still must prepare and file the return, bearing the full compliance cost for a $0 liability. The compliance burden is the point. The tax is zero, but the cost of proving it is not. There is a structural flaw in DC's revenue model that no amount of rate adjustment can fix. Federal law prohibits DC from taxing the income of non-residents. A business owner who lives in DC and moves to Virginia or Maryland continues to work in DC but stops paying DC income tax. The neighboring jurisdictions impose lower rates. By point of reference, Virginia's top individual rate is 5.75%, while Maryland's top rate is 5.75%, with local surcharges that vary by county. Both are lower than 10.75%. Every DC resident who moves across the border to a lower tax jurisdiction and continues working in the district represents lost revenue that the district cannot recover. The incentive structure pushes high earners out, and DC has no lawful mechanism to stop it. Federal workforce reductions add another dimension of risk. DC's economy is concentrated in government and government adjacent sectors. Cuts to the federal workforce reduce incomes, reduce consumer spending, and reduce the individual income tax base that funds 29.8% of DC's total revenue. The Pew Charitable Trusts identified federal workforce reductions as a risk factor for state and local budgets, and no jurisdiction in the country is more exposed to that idiosyncratic risk than DC. Florida, in contrast, imposes no state level personal income tax. Similarly, Texas imposes no state level personal income tax either. Neither jurisdiction imposes an estate tax at the state level, a GILTI tax inclusion, or a compliance only filing requirement for zero liability businesses. The difference between 10.75% in DC and zero is not marginal. To put that in perspective, on $500,000 of pass-through income, that is $53,750 per year over 10 years. That is over $537,000. That's a house. Now, redomestication is the lesser known legal process of transferring a company's state of domicile to a new state without dissolving it, without creating a new entity, and without triggering federal income tax when performed with the required formalities under the Internal Revenue Code. The company retains its existing federal employer identification number, contracts, credit history, and bank accounts. Foreign entity registration, in contrast to redomestication, does not change the company's domicile. In fact, it keeps it in DC indefinitely. A traditional merger, which is also not the same thing as redomestication, creates a new entity and can trigger tax consequences. And finally, dissolution is really not an option at all because dissolution terminates the company. Dissolution is the legal equivalent of burning down your house to relocate to a new neighborhood. Redomestication, when paired with a change of personal residency and a reduction or cessation of business operations in the district, can reduce or even eliminate tax exposure for the entity and its owners there. DC collects more tax revenue per person than any other jurisdiction in the United States, and yet still carries the highest per capita debt burden. The top rate is almost 11%. The neighbors charge half that. Some states, like Florida and Texas, charge none. The federal workforce is shrinking, and the math does not improve by waiting. I have personally assisted a number of companies redomesticate out of DC with a 100% success rate to date. If someone is telling you it's impossible to redomesticate an entity out of DC, I encourage you to seek a second opinion from knowledgeable legal counsel. If you have questions regarding redomesticating your existing LLC or corporation, please use the link in the description for more information on this legal process and to schedule time for you and I to speak one-on-one about your specific situation. Again, my name is Chad Cummings, and I hope that you found this information helpful. As always, the information in this presentation is general in nature and is not legal advice, because legal advice, by definition, must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my earlier presentations, please visit my firm website at www.cummings.law to schedule time for a consultation. I look forward to the opportunity to speak with and perhaps even work with you very soon.